What is corporate bond and how to invest in corporate bonds? That's a topic for discussion in Market Secrets investment series today. Bonds that are issued by private and public corporations are known as corporate bonds. In the previous episodes, we learned about the bonds issued by the government, but governments are not only entities that raise the debt through bonds. Bonds that are issued by private and public corporations are known as corporate bonds. Companies may issue bonds to raise money for a variety of purposes. For example, to raise money for a new plant, and these bonds act as a way for people to lend money directly to the company. But there is one important factor here. Not all bonds are made equal. If you have compared fixed deposit rates at various banks, you would have noticed the big three banks, that is SBI, HDFC, and ICICI, tend to have lower interest rate on their fixed deposits when compared to smaller players. The other end of the spectrum tends to be small finance bank, which offer a good 3 to 4 percentage interest additionally over what a major bank would offer. This difference in the rates is due to the risk, and the same applies to the bonds issued by the companies as well. Bonds issued by robust blue chip companies has a much lower chance of default than the one issued by a shaky, unprofitable small cap company. There needs to be a way to gauge this risk, and that is why we have something important known as credit rating. Credit ratings are like CIBIL score for companies. There are multiple agencies which provides credit rating for companies like CRISIL and Brickwork. Generally speaking, a company issuing a debt will get themselves rated by one or more of these agencies, and they will issue a grade to their company based on the category. There is a separate rating and rating scale for each type of the debt issued. That is a long-term debt and short-term debt and FDs. As the name implies, each rating is tailored for a specific type of debt security issued. Each rating agency has their own scale which is publicly available, but most ratings go from AAA, which is the safest, to D, which is default, with the triple B being the lowest possible grade for an investment grade debt. Any debt with a rating less than triple B is considered to be junk debt and often will not get investments from pension funds, mutual funds, etc. due to guidelines by their regulators. Some bonds are considered to be pseudo SOV rated. These are generally bonds issued by public sector units and public sector banks, and there is an assumption that the government will recapitalize these entities in case of a default. There is some merit to this argument, but it is prudent to assume some risk as there is no guarantee that the government will bail out the bondholders of the PSUs and PSBs. Credit ratings are a useful metric to analyze the overall risk, but it is important to note that these ratings are merely a reference, and taking these ratings at face value can backfire, and history has several examples of this. For example, the meltdown of AAA rated mortgage backed securities, which is MBS, during the 2008 financial crisis is the best example we can find on credit ratings and its misuse. Instead of rating bonds, some of these rating agencies almost sold the ratings to the companies. So even junk bonds were rated as AAA, which ended in major crisis. So do not just follow the credit ratings. Do your own research on the company as well. Moving on to the types of corporate bonds, there are a couple of types of debt-based securities that companies can issue, and these have different consequence both for the company and the investor. One of this is corporate fixed deposit. Corporate fixed deposits are similar to bank deposits but not same as bank deposits. Similar to how you would create an FD in a bank, you can deposit a variable amount of money for a duration of your choice provided by the company. Unlike a bond, these are not market based, which means liquidity is provided entirely by the company you are investing in. If you want to exit a traditional bond, then you can do that at the time by selling the security in the secondary market, that is, in the exchange just like BSE or NSE through your broker. This is not possible with corporate fixed deposits as these are not listed in the secondary markets. If you want to get your money back early, then you need to go through their early withdrawal process, which may have a penalty of 1 or 2 percentage on the interest. Furthermore, it is very important to note that corporate fixed deposits are not backed by RBI and DICG's 5 lakh rupees insurance. So if the company goes insolvent, then there is a risk of default, and the only option for you would be either to sue or wait to get the proceeds from any resulting liquidation process. The reward for taking this risk is usually much higher rate of interest over the bank fixed deposit rates. In terms of taxation, these are taxed similar to the bank FDs and the tax is deducted at the source unless you provide 15 GRH form if you are under tax slabs. So with that, we are closing today's session on corporate bonds. So are you invested in corporate bonds? How was your experience? Let us know in the comment section. Also, if you have any queries, comments about this episode or this series in general or investing in general, feel free to let us know in the comment section. We'll be happy to answer and address it. Also, if you're interested, you can check out our website for various other learning series and also multiple live data feeds, which will help you to become a better trader in the market. Also, hit the like button if you have liked this video and share it with your friends if you find it useful. Also, subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.